Hi, I'm Don Thompson, real estate broker with the Pioneer Group, and I'm here today to talk about mortgage insurance, also known as PMI, which technically stands for private mortgage insurance. And what that is that's when you put less than 20% down on a mortgage today, the lenders are causing you to buy mortgage insurance, which basically protects them against your default. And so I've asked Jason Jean, the mortgage machine, to come back again today to explain to us what his take is on this mortgage insurance and give you some insight on the questions you should be asking, and so you'll know what direction you might want to take. Jay, thanks for coming again today.
Thanks for having me.
Okay, so give us a little bit on this mortgage insurance and how that works.
Okay, so first of all, no one likes paying PMI.
Oh, I hate insurance.
Nobody likes paying it. But
sure glad I got it when I hate it.
The good news is that you don't have to save up 20% to buy a home today, okay? And what that's done is really allowed a lot of people to take opportunities on the market rather than saving, because we all know that you're probably paying rent if you don't own a home already, and that rent is probably going to be somewhat similar to the, to the housing payment that you're about to take on. So just to describe the difference, Don mentioned mortgage insurance, and he mentioned private mortgage insurance. The difference between the two is it's not really a big difference. The difference is because of the government loans have their own mortgage insurance. So you're not using a private company, which is why they leave off the P, or it's just MI, or mortgage insurance. And there's really not a big difference other than the calculations that we arrive at a dollar amount. It's all based on loan amount. Okay, and different programs, you're going to go with a different program based on what the interest rate is on the loan and what the rate is on your PMI or MI. Okay, and we generally use the word PMI to be synonymous with all programs, even though it's not really correct. But for the sake of conversation, it's easy just to all say it's all PMI. But what we're going to do is we're showing you a chart here that outlines a scenario where you have a $200,000 loan amount. And there's various loan programs up on the screen, and the different rates are calculated for the different programs. So you'll notice that the absolute cheapest for a monthly PMI is going to be on the VA loan, and that's for the veterans of the military. You also have a very, very low, dollar amount for the USDA or Rural Development Program. And make sure that you watch all the individual videos for the different loan types because we get into greater detail in those. The FHA, you can see, has the highest amount for the monthly mortgage insurance, so that might be something that steers you away from the FHA program. But the conventional, you can kind of see is middle of the road. Now, that will change depending on down payment, depending on credit score. So it's very, very driven by those factors. So you're going to want to make sure you discuss, what your dollar amount would be for the conventional loan. So those are the different types of the mortgage insurances and how much they can vary. The other type of mortgage insurance that you don't really hear too much about is what's called a single premium mortgage insurance, and that's for conventional loans only. And instead of paying that monthly fee that you saw on the screen before, the single premium mortgage insurance is a one-time, upfront, typically out-of-pocket expense at closing. So you can put 5% down on a conventional loan, and instead of paying the monthly cost, what you're going to do is you're going to pay the one-time fee. That fee, again, depends on your down payment, depends on your credit score. It can be pretty steep, but when you do the math, typically you end up saving about 50% in the overall cost by the time your mortgage insurance does come off of your loan program. The government types of loans, which we did discuss, also, in addition to your monthly cost, do have something that is similar to the single premium, although it does get rolled into the loan amount, and that that will be discussed in further detail in the individual loan type videos.
Okay, well, thanks, Jason, and we appreciate you coming. And if I could just kind of recap here, mortgage insurance, again, is that insurance that you pay to the lender to ensure that they're insured against your default. The different programs have different calculations, different rates, And you want to make sure you're checking with your local loan officer like Jason to make sure that you understand what you're getting into and that you're getting the very best. Because basically you want the best mortgage payment. You know, interest rates, mortgage insurance, interest rates, when you combine them all together, what's going to be your mortgage payment and how long you're going to have to deal with the mortgage insurance and all those good factors. So anyway, I want to thank Jason again for coming today. We really appreciate your insight on this. For more information about the home buying process and the mortgage process, please visit our websites below. Also, please like, share, and subscribe to our channel. This is Don Thompson, real estate broker with the Pioneer Group. To your success, have a great day.